All right, good morning, everyone. Thanks for joining our webinar series with Frost Law on the Employee Retention Credit. Before we get started, we have a quick word from our sponsor, United Bank. As the community bank of the nation's capital, United Bank is proud to be a sponsor of the What's Up Media webinar series. United Bank has been serving the greater Washington, D.C. region for over 30 years, providing a testament to their continued stability and reinforcing their position as a reliable banking partner. Backed by a history of safe, sound, and secure banking practices, United has navigated changing economic environments while staying true to their mission of excellence and service to their employees, customers, shareholders, and communities. They have the technology, products, and expertise that you'd expect from a big bank, but with the personal touch and local financial decision-making only a community bank could offer. They are proud to be the bankers you know and trust. For more information, visit bankwithunited.com. All right, and now I'll turn it over to Frost.
Hi, thank you so much, August, for having us here today. We really appreciate the opportunity. Just to give you all some background, Peter and I are tax controversy attorneys. And what that means is, pre-2019 or pre-2020, we would help clients, usually business owners that are kind of on the bubble of viability, that have some sort of, disagreement with taxing authorities, whether that's the IRS or state jurisdictions, whether it's, payroll tax or sales tax. There was some issue where the business owner wasn't able to pay its taxes properly, or there were audits and things like that. But a lot of the time it was that the business wasn't able to pay sales tax while also paying all of its other expenditures. So Peter and I would kind of work with these businesses and get them on the path of compliance and viability and able to work with them in order to get them to be sound. Well, when COVID hit, all of our clients that are kind of on the bubble were about to get blown away. And so what we really needed to do is dig down deep into the CARES Act and help people with PPP. And you might have seen us actually talk about that at one point, a couple of years ago. And then also with the FFCRA and ERC, Restaurant Revitalization Fund, all of these things to help our clients stay in business and be able to maintain their business and, continue on. So what we learned during that process was that there are also a lot of businesses that were not on the bubble of viability that didn't know about these things. We believe it's because so much was going on with PPP. There's so many different updates and guidance suggestions and all of those other things. I actually remember the Friday before Memorial Day weekend 3 years ago or 2 years ago, Peter and I had a new guidance drop at 8 p.m. and we had a webinar on this Tuesday and we had to learn it over the weekend. So luckily that didn't happen this time. We were able just to talk about ERC, but because of all of this different stuff with PPP, as the legislation changed, people kind of got fatigued. And so they weren't able to, communicate it with you or communicate it with their clients. So in the beginning, and Peter will go through this a little bit more clearly, but in the beginning, you couldn't use PPP and ERC together. And that didn't change until December of 2020. So at that point, that's really when we started kind of pivoting from PPP and started paying much more attention to ERC and how to help our clients with the employee retention credit. I'll let Peter kind of go through that legislative process and what it looked like.
Sure. So Rebecca touched on a couple of these things, but let's just, quick crash course in how we got to where we are. CARES Act had a bunch of different things in it. The big one was the Paycheck Protection Program. If there's one that you learned about, it was probably that. At the time in the beginning, Paycheck Protection Program was worth $15,000 and change per employee, and the employee retention credit, if you could get it, was only worth $5,000. So PPP took all the air out of the room. A lot of folks did get familiar with FFCRA, Families First Coronavirus Response Act. That was part of the legislation that allowed a credit for taking care of your basically being off work because you contracted COVID or you were caring for a close family member who had COVID. Employers could get credits for that. There were deferral of employment tax Social Security tax payments for employers, where they deferred their 2020 Social Security taxes. They paid half at the end of 2021 and half at the end of 2022. There was this employee retention credit, but again, in the beginning, you couldn't get both. And so if you could get PPP, that's what you went for. Other things, there was a shuttered venue operators grant. There was a restaurant revitalization fund. And then, of course, there was the EIDL loans, economic injury disaster loan, which was an existing program, but basically the president said everywhere in America is a disaster. And so it opened up that opportunity for businesses. You know, at the beginning, you couldn't do PPP and ERC. So everybody went for PPP. It was way more lucrative. All of that changed on December 27th, 2020. And that was the Taxpayer Certainty Disaster Tax Relief Act. They've sort of been calling it the Relief Act. That said, hey, just kidding, you can actually get both. And not only is it, you know, no longer worth just $5,000 per employee, you can also get it for quarters 1 and 2, and now it's, you know, potentially worth $19,000. Then the new administration comes in, and in March there's the American Rescue Plan, and that extends the credit even further into quarters 3 and 4 of 2021, and that's what, you know, at that point you could get up to $33,000 per employee. You know, and just to keep everybody on their toes, they changed it again in November of 2021 and pulled back a little bit. They took away the fourth quarter in most circumstances, and we'll get into some of the nuance there, but that's where you get to the 26,000 is the first 3 quarters of 2021 plus the calendar year for 2020. And just so you know, we're not making all this stuff up. You know, they haven't come up with quite as much as they did with PPP, but they have come out with several notices that generally track the different legislation that's changed. Notice 2021-20 is really the big one. There are revenue procedures 2021-33 and 2021-48 that sort of help us understand how to think about PPP and ERC together. And just to lay some groundwork and a launching off point for Rebecca to get into it, this is built on existing Internal Revenue Code stuff. This isn't like PPP where you had to go to the bank, you had to apply to them, you used your money in certain buckets, and then you went back to the bank and said, hey, you know, give me loan forgiveness. This is existing stuff. You're claiming it on forms 941, or, you know, hopefully most of you already filed your 941s, and this is an amended 941 situation. But, you know, payroll taxes are, you know, self-assessed by employers who report wages that are paid. You know, FICA taxes are Social Security and Medicare. Half is paid by the employer, half is paid by the employee. Additionally, the employer withholds taxes to remit to the government on behalf of the employee. That's sort of the sandbox that we're playing in as far as, you know, the mechanics here. And I'll pass it back to Rebecca to jump into the actual credit.
What is the credit? What are we talking about? Legislative history is important. How do we get there? But you really want to understand how you can get a credit for your business, right? So, like we said before, all of the legislation as it continued to roll through the pandemic, and you know, I guess Congress has decided we're done. But as it went on, it got better and better and better for employees. So in the beginning, or employers, I'm sorry. So for PPP, at first you had 8 weeks to spend all this money. Then they're like, okay, forget it. You've got 24 weeks. You can pay your people $40,000. They gave you all these extra incentives to be able to use this money. So proprietors could use it, nonprofits could use it. Same thing for ERC. In the beginning for 2020, it's a $5,000 credit max per employee, which is comprised of 50% of up to $10,000 in wages total. And for restaurants, it's pretty cool. You guys actually get to count tips for your employees as long as you report them properly on your 941. So it's money that you never really spent, but you're going to get a credit for it. That's for 2020. As the new legislation came out in December of 2020, instead of 50% of up to $10,000 in wages per year, per employee per year of 2020, 2021 is 70% of up to $10,000 in wages per quarter. And that's like what Peter was saying before, that's the $21,000. So if you're eligible for all these quarters, you're going to get up to $26,000. It's a lot and it adds up quickly. And, again, it's something to think about, for restaurants, the tips angle is really nice. You're able to count the tips of your employees as qualified wages.
Just to jump in, don't get bogged down on the percentages, right? It's a tax credit that is based on wages paid, but comes back to you, as a refund. But the percentages just get you to those dollar amounts.
Just gets the money, yeah.
Yeah.
So who gets it? How do you get it? So that's how you calculate it. Who gets it? An eligible employer is able to apply for it. So an eligible employer is an employer which is carrying on a trade or business during the calendar quarter for which the credit is determined. So this is important if somehow you no longer are owning the business that you owned in 2020 or 2021. And we can talk to you offline about exactly how that works, but you have to own it during the period of the pandemic. And there's two ways to qualify, either a gross receipts test or a restriction/partial restriction test. The gross receipts test is the easiest one, and it's what we tell everyone to do first. First, look at your gross receipts and see if they went down by the required amount. And if so, you're eligible. You don't need anything else. The gross receipts don't need to decline because of COVID. We've got clients that lost contracts and they decline that way. And they're still eligible. They can decline because you shuttered operations because you wanted to and you were always planning on doing it. There's no reason tied to the gross receipts test. All it has is the gross receipts have to decline. So how much? Compared to 2019, quarter over quarter, for 2020, the gross receipts have to decline 50%. A lot. For 2021, as we said, everything kind of got better for employers. You only have to decline 20% quarter over quarter compared to 2019. It's a much easier standard to get that much bigger credit. There are alternate reference periods for 2021 that allow for automatic qualification for successive quarters. So for Q1 of 2021, if you dropped 25% and then in Q2 you crushed it and went up 80%, you're still going to qualify for Q2 because of that Q1 decline. It's a little bit complicated, but it's way easier than the partial suspension test, and something that you can empirically just look at and know that you qualify. Now, for full and partial suspension for restaurants, this is actually not bad. I don't know how many of you are restaurants and how many of you are something else that decided this date worked out better for you all. So I'm going to go through it regardless. But partial suspension is when your operation of your trade or business is fully or partially suspended during the calendar quarter. Now, remember, all of this goes back to the 941. So everything is based on a calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings. So the government had to shut you down. So for restaurants, you were an essential business. The government said specifically, you are supposed to be open, help feed the people. But we don't want you to be open fully. We want you to close your indoor dining operations. You can still do takeout, but you can't operate the way you were doing in 2019. Now, as long as you were restricted more than nominally, and the IRS looks at nominal as more than 10%, then you're going to be included in this partial restriction, partial suspension litmus test. So for most restaurants, indoor dining represented more than 10% of its sales in 2019. And that's what we're looking at. More than a nominal portion of your business operations were impacted. And therefore, you're going to qualify for as long as those orders restricted you. Like for Baltimore City, it went through July 1. Annapolis, I want to say was May 15th. Other parts of Anne Arundel County were March 15th. You really have to look at that government order and have it tie back. So this is different than the gross receipts test. Here, your gross receipts can go up. I have a client who killed it on takeout and their revenue went through the roof, but they were restricted. And so they're going to qualify, but they have to be restricted and it has to be because of COVID. That's the difference of this test than the gross receipts test. So this is just about restaurants specifically. So restaurants are eligible. Government orders throughout the country restricted many restaurants from serving patrons indoors. For most restaurants, indoor dining represented more than 10% of total gross receipts or hours worked in 2019 per quarter, meaning the restriction affected more than a nominal portion of business operations. Even when indoor dining was later allowed, capacity restrictions continued to impact more than a nominal portion of business operations. So 6 feet restrictions, 50% capacity restrictions, all of that type of thing, still a restriction. Additional conditions of reopening, such as maintaining a certain distance between tables, may have also had a more than nominal effect on the ability of the restaurant to provide goods or services in the ordinary course. If you don't believe that that closing indoor dining is more than 10% of your revenue in 2019, maybe you opened in January of 20, then talk to Peter and I, we can talk about a different test that could qualify you. It's called the nominal effect test. I'm not going to get into that because I think most restaurants are going to be eligible based on that nominal portion test, but there are other ways to qualify. So don't be discouraged if that's the case for you. 5.
So there's actually a third way to qualify. This is a much smaller category, but the American Rescue Plan introduced a third type of eligible employer. This is where the business began operations after February 15th, 2020. They have average gross receipts of less than $1 million, which may be difficult for some businesses, just based on their revenues. You can't qualify under method 1 or 2, and this eligibility method is only applicable to quarters 3 and quarters 4 of 2021. So basically, you started a business during a pandemic, and it was successful enough to stick around, and you had employees in quarters 3 and quarters 4. It's basically rewarding you in that scenario. These are, one thing to mention is that these are all separate tax returns, separate quarters. Rebecca said previously on the couple slides before, these are all per quarter, right? So you could qualify on, a partial suspension test in one quarter and be a recovery startup business in another quarter. And so you need to work through how you become an eligible employer in each of the separate calendar periods. That's why we said start with gross receipts, because that's the most black and white. You're just pointing to dollars in the door, right? But this is a situation where if you started after February 15th, 2020, you are the only type of business that could qualify for the employee retention credit for Q4 of 2021. The other catch, with these is that these are limited to $50,000 per quarter. So if you are only qualifying based on recovery startup business, then you're capped at $100,000, $50,000 for Q3, $50,000 for Q4. So all of the conversation up to this point has been eligible employer, but just because you're an eligible employer doesn't necessarily mean that you have qualified wages. And again, the qualified wages is up to $10,000 for all of the year for 2020, or for $10,000 per quarter for 2021. So once you determine that you're an eligible employer, then the question is, well, what qualified wages have I paid? So qualified wages in general are your W-2 wages that you pay. For restaurants, Rebecca mentioned it earlier, you can claim tips as long as you've appropriately accounted for them. It can also include health plan expenses, which are the pre-tax dollars that an employer pays on behalf of an employer to maintain health insurance. The big catch when it comes to qualified wages has to do with your full-time employee count in 2019. So Congress said that if you have more than 100 full-time employees in 2019, for 2020, that means that you had to be paying them not to provide services. So if you have more than 100 full-time employees in 2019 and you're going to claim the credit for 2020, the only wages that count as qualified wages for the purpose of the credit are those wages paid to someone to stay home, okay? It's not a cliff. you could pay someone both to work and not to work. So maybe you only needed them for 10 hours a week, but you did the right thing and you knew they had kids at home, whatever it was, you paid an extra 30 hours that they weren't working for. That 10, if you're a large employer, you're not going to be able to claim ERC for, but the 30 that they were at home not providing services for the company, that counts. To Rebecca's point earlier, they keep making this easier, in addition to more lucrative, dollars and cents wise, but they popped the full-time employee count in 2021 from 100 to 500. So it's going to be easier to qualify. One thing to mention is that you're not doing a full-time equivalent. So this is a full-time employee, which is grabbing definitional stuff from the Affordable Care Act. So full-time employee means someone who is working 30 hours per week or 130 hours per month. Back to Rebecca.
He says that because I never remember what I'm supposed to do. Limitations on and refunds. So we've talked about wages taken into account. The amount of qualified wages credited by the eligible employer for any calendar quarter shall not exceed $10,000. So that's all you can take for ERC. It's something to think about, and we'll get into this a little bit later, but when they did this expansion where they said, okay, you could do PPP and ERC and all these other things, you can't double dip wages. So ERC is going to be $10,000. I might use $20,000 of Peter's salary for PPP, 10 for ERC, and 5 for FFCRA. And that's all fine. You have to just figure out exactly where your wages are coming from. Recovery startup business. In the case of an eligible employer, which is defined as a recovery startup business, which Peter went through, the credit allowed under any calendar quarter shall not exceed $50,000. Refunds of excess credit. If the amount of the credit exceeds the limitation set forth, this is the most important one. So if you're not listening, you should start right now. It's going to be refunded to you. So this was all written, while it was happening. Real time it was happening. Your wages, your revenue went down in Q4 of 20. You're eligible in Q1 of 21. Some people didn't pay their tax deposits. It was the first time as a tax attorney, I could tell people they didn't need to make their deposit. Here, you guys have made all of your deposits, hopefully. And therefore, your credit is not some weird NOL carry forward. You get $2,000 every year for 20 years or whatever. This is actual cash. You're going to get a check for each quarter that you're eligible for once everything is processed. So this is a really big deal. It's just a mechanism it's a way for the government to get you some money. They called it a weird thing. They're trying to make people bored with it by calling it a tax credit. But in reality, it's just a way for the government to say, oh, you kept your people employed and kept them off unemployment. Hooray, here's some money. We're going to send you a check. Slide. So this is what I was talking about before. You can't use these things all together, but you can use them as long as you separately quantify your wages. So what we do when we prepare these, and you should make sure that if you're going to your accountant or whoever is preparing the stuff for you, is that they're doing the same thing, which is it's a PPP work paper. And you want to make sure that if I look at, Peter's wages and August's wages and everything else, I can see clearly what went to PPP, what went to FFCRA, what went to ERC each quarter, and the total amount of forgiveness for PPP and the total amount that you use for ERC all needs to be accounted for. So that way in 2 years, if somebody comes knocking and says, hey, why do you think you're authorized for this credit? You can be like, this is exactly why. Here's my work paper. I relied upon it from my accountant, from my attorney, whomever, and this is why I took this amount of money. Now, similarly,
there's some strange rules with RRS too, since we're talking to restaurants. If you got restaurant revitalization fund, you want to slow down and make sure you're doing that correctly as well.
Yeah, there's a couple credits you can't use it for, and a couple credits you can use it for, quarters you can use it for. So you just want to be really careful because that's a lot of money to use. You want to make sure you're doing it appropriately. But that's basically what the slide is how to segregate all of your wages. And then just similarly, in addition to the work paper, I usually talk about this when I talk about the government order, but I didn't this time, just to keep Peter on his toes. We also, what we do is write like an opinion letter that says, like, based on this government order, Larry Hogan shut down the state's indoor dining from March 13th, 2020 through March 15th, 2021. The Annapolis mayor kept that indoor dining ban on until May 15th, 2021. Therefore, restaurant ABC is eligible for these credits because they have indoor dining. The indoor dining was impacted. It's more than a nominal portion. So we write this whole thing to explain why somebody is eligible. And it's the same type of thing that you should be asking your person, whoever your tax professional is, to do for you. So that way you have a nice little packet to hand somebody in 2 years when they're going to ask you for it. They're going to say, how do you know how much credit you should get? And you're going to give them that work paper. And they're going to say, and why were you eligible? And you're going to hand them that letter. I reasonably relied upon my attorneys who did due diligence and determined that I was eligible, and this is how much. So that's my spiel on that. How to claim the credit. It's still me. Eligible employers will report total qualified wages and the related health insurance costs for each quarter and tips on the quarterly employment tax return, the Form 941. I talk about how much I hate the Form 941. I did my first one in 2014 when I hired a nanny for my 3-month-old daughter. And it was terrible then, and it's gotten 4 times as bad because they've added 4 pages to it. And it's much more complicated now, but that's how you're doing this. You're doing a 941X, an amended 941. This is a worksheet that goes with it to determine how much credit you're allowed. Again, this goes into your packet. This is going to go into your box of information of what you're going to give that auditor when they say, okay, how much credit are you entitled to? This is a pain in the butt, but this is how you do it. It's the only way.
All right,
Now
my
we're
turn.
gonna talk about the other things that are going to go into the box.
Right. So Rebecca alluded to it earlier, but we did a lot of these talks related to PPP first, and we would have clients and taxpayers say, "Hey, what are they going to ask for? What do I need? What's the bank going to want? Do I have to show my incorporation documents? Do I have to?" And we had best guesses and what we could share from our experience with working with one particular bank or the other. In this situation, the legislation actually said, hey, Treasury Secretary, you have to tell us what you're going to want if you come and audit this, because this is just like any other tax return. The government has the authority to come in and audit you. So this is what they've said. They said governmental orders or ordinance that caused either shutdown or partial shutdown. So if you're qualifying not based on gross receipts, but based on that closure of indoor dining or capacity restrictions, something like that, you need to actually go and find the governmental order. Maryland has been decent, I would say, with keeping their stuff available and accessible. Keep in mind, though, that it's not just Governor Hogan. It goes down to the county executive or county health board. It just needs to be some governmental order. We didn't get into it too much, but governmental orders, they need the weight of law behind them. It's not a comment from a politician at a press conference, and you're looking for shall language, not should language. But actually going and finding that is of critical importance. If you are qualifying not based on partial shutdown, you need to be able to show that decline in gross receipts. Again, 50% in 2020. You remain eligible until you come back above 80% of what they were in 2019. If you're qualifying in 2021, you need to show that 20% reduction in gross receipts. Again, that's the most black and white. That's a non-COVID reason. It's just you need that reduction, but you need to be able to show it. Records of qualified wages. So the first 2 points were, am I an eligible employer? Then you get into qualified wages. So, for the most part, these are total pay reports, pay stubs, things like that. If you're a large employer, meaning you had more than 100 full-time employees in 2019, claiming a 2020 credit, or more than 500 full-time employees in 2019 claiming a 2021 credit, you need to be able to show that you were paying folks not to work. That can be challenging. Hopefully you had a separate line item on a pay stub, something along those lines. I guess pay stubs themselves or time cards would be helpful, something along those lines. But you need to have something in the file if you're a large employer. If you're adding in health plan expenses, you need to be able to show, your expenses. We'll get into it, but there are some catches with this. If you are a member of a controlled group, you need to be able to provide information related to the other members of your controlled group. Copies of completed Form 7200. This was in advance. The government thought that they were going to be able to process these and get cash in people's hands, to keep businesses afloat. I'm not aware of any of these that actually worked, but they're not a thing anymore. So, if you haven't already filed a 7200, you're not going to now. But it was basically you could claim an advance credit before you even went and filed your 941s after the period had ended. And then just keep copies of your returns, retained documents. So the notices say retained documents for 4 years. There is, if you've claimed a credit for Q3 or Q4 of 2021, a 5-year statute related to it. And we'll talk about that in this next slide. So a lot of this sounds, really good, maybe a little too good to be true. So there's some catches, and there's some places where you need to slow up and potentially talk to a professional. This first one, ownership aggregation rules may apply. So again, this is built on existing tax law. And what they've said is that, if you have common ownership groups, brother, sister, corporations, parent, subsidiary, there's combination groups, you may have to consider everything for the purpose of the credit. And if you are a member of a controlled group, you are considered one employer for the purpose of the credit. So this can be a good thing, meaning if your indoor dining represented not less than 10% of gross receipts or hours worked across all of the control group members, you may be able to qualify a related construction company or daycare or whatever it is, that if they're the member of the control group, it's treated as one employer. That could be a good thing. Could also be a bad thing, in that if you're a member of a controlled group, you have to use that employee count across the board. And so maybe it pops you above 100 for 2020, but now you're aggregated and maybe it doesn't pop you above 500. And so it's a good thing because it's more lucrative to have the credit in 2021 anyway. Point is that if you've got common ownership among multiple entities, you need to slow down and consider whether or not you're a member of a controlled group. Additionally, 50% plus, so a majority owner's wages are not considered qualified wages for the purpose of the credit. There are also situations where if you have family members of majority owners working in the business, they are considered deemed owners, and therefore their wages would not be considered qualified wages. So both of these first two rules are existing tax law stuff that Congress said, hey, by the way, this stuff that we've already been working on, it also applies in this situation. If you acquired a business during 2020 or 2021, or a portion of a business, you need to slow up, especially with respect to the gross receipts test. There are safe harbor rules and information about how you need to think through those issues. Sole proprietor income is not eligible, so this is different than PPP. In PPP, if you were a sole proprietor and you filed on Schedule C of your 1040, everybody was asking you to real quick prepare 2019 Schedule C, tell me what your line 31 net business income was. That doesn't work in this situation. You had to have had employees. So sole proprietors can still have employees, but that sole proprietor sort of net business income is not going to qualify for the credit as a qualified wage. Household employers aren't eligible. So Rebecca's nanny, you're not going to be able to get, employee retention credit for their wages. The assessment statute of limitations. So typically the IRS has 3 years to come in and propose a change to a tax return. Congress in the American Rescue Plan extended the statute of limitations from 3 years to 5 years, but it wasn't retroactive. So it only applies to quarters 3 and quarters 4 of 2021. So if you claim the credit, just be aware that government could come in and audit you, for a longer period of time. What they didn't do, however, is they didn't expand the refund claim statute. So that remains 3 years. And again, each of these tax returns, you're just looking at calendar quarter, calendar quarter, calendar quarter. Each of them has their own refund statute. So the first one, the oldest quarter that you could have claimed the employee retention credit for was quarter 2 of 2020, plus 3 years from the due date is July 31st, 2023. So you have a little bit of time, but it's coming up. And we haven't really talked about it, but these things aren't, flying out the door at IRS. It seems like it's getting better. A couple of months ago, we read something that said they were 9.5 employment payroll tax returns behind.
9.5 million.
9.5 million. Yep. Something came out last week, I think, and they're down to 3.8 million. So still behind, and that's only payroll tax returns. So
We're doing better.
it's getting better. We've still spoken to people who have been waiting a year. We've also seen some
The
that we've
newer stuff
filed.
is going faster, yeah, for whatever reason. So good that you waited. Your stuff will get
Yeah, right.
lightning faster.
I think the fastest we've seen is 5 months. So somewhere between 5 months and a year, it should be processed. Then the last big catch is, again, existing IRS law, code section 280C says that if you get a credit based on wages paid, you have to reduce, your deduction for wages paid by the amount of the credit. What that means in many cases is that you're going to have to go back and amend your business tax return. Depending on your structure, that may trickle down because you're going to be amending schedules K1, and it's going to go to the individual partners or shareholders, who then are going to have to amend their individual income tax returns, Form 1040. In almost all circumstances, even though you're going to be paying tax on the amount of the credit, it still makes sense to do, because again, this is a refundable tax credit worth up to $26,000 per employee. It sort of rips right through the tax that's due and comes out as a refund. And again, unless it's a very small credit, it's in almost all circumstances still makes sense to claim it.
So people call us and they're like, "Oh, Rebecca, $80,000. Is it worth it?" I'm like, I don't know. Somebody came in about an $80,000 steak, it'd be worth it, right? Like, it's income, yeah. So you do have to pay taxes on it, but like, it's still $80,000. Even if you have to pay somebody to get the credit, to like prepare the forms and do the letters and all that, you're still walking away with tens of thousands of dollars that you didn't have before. So don't get discouraged just by simple, it's a pain to get. And it is, sure, it's a pain. You have to do amended 941s, which I've already said 941s are miserable. The amended 941 is worse. You got to put your ducks in a row. But I mean, you're talking about a lot of money, even if you do have large PPP loans, they're going to offset and all of that. I mean, we've really seen the gamut of refunds. We've got smaller cases where they're getting, $25,000. And then we've got big ones that are getting like $1 million. People who had no idea that they're eligible. People had no idea that this even existed, that we educated them on. Their CPAs told them they were not eligible specifically. We told them that was incorrect. Explained why. And, talked to their CPAs and educated them as well. And, now they're going to be getting quite a substantial refund. So if you've been told that you're not eligible before, just take it as a second thought. And we're happy to talk through anything with people. This is an area of law that's going to be around for a couple more years, and we've become very knowledgeable about it in this time. So we're happy to share that knowledge and, help business owners, and especially restaurants. You guys are hit hardest, throughout this thing. and God only knows like what's going to happen in the fall. So anything we can do now to kind of help prevent some sort of second wave or third wave or whatever, you know, we're happy to do. I mean, we can take questions if people are interested. There are none here.
Yeah, if you have any questions, feel free to put them in the chat box or the question box.
Or you can reach out to us afterwards. That's fine too.
Yeah, should they just reach out to you through email?
That's fine. That's fine.
Email's good. The number on our headquarters is good as well.
Well, thank you so much. We really appreciate it. We appreciate the opportunity. And we'll see you next time.
Yeah, thank you both.
Thank you. Take care.
Thanks, everyone.